Welcome to today's Council on Foreign Relations meeting, the World Economic Update. This series is dedicated to the life and work of Martin Feldstein, the distinguished economist who was a mentor to many of us. We're meeting at a time when the global economy faces some pretty clear headwinds. The conflict in the Middle East, which I guess may or may not be over, has pushed up energy prices, fueled inflation, raised borrowing costs. Volatility in trade policy has not helped either. And so the World Bank just published a new forecast projecting that global growth will slow to 2.5% in 2026. That's down quite a bit from 2.9% last year. And it's the weakest pace, by the way, since the onset of the COVID-19 pandemic. And meanwhile, we have a red-hot AI boom with enormous amounts of capex, fueling demand in the US, stock markets hitting records. So as usual, it's a paradox. We're living in interesting times, and luckily, we also have an interesting and all-star panel. We have Jan Hatzius, furthest over there, Chief Economist and Head of Global Investment Research at Goldman Sachs. Doug Rediker, Managing Partner at International Capital Strategies and also at Brookings. And next to me, Natasha Sarin, Professor at Yale and co-founder of the Yale Budget Lab. And Doug, I thought I'd put the first question to you, picking on you, if you don't mind. Obviously, it seems pretty unclear whether this week's agreement on Iran is really going to stick. But let's step back and just talk about how the geoeconomic shifts from this war, what they've revealed. I mean, Iran has discovered a new power over the Strait of Hormuz, an ability to hold the world economy to ransom. China has reminded all of us of its ability to think in a strategic way about geoeconomics, its big oil reserves and its willingness to draw from them was a big reason why the oil price didn't spike quite as much as the gloomy forecasts expected during the war. And it strikes me that neither of these developments is particularly great for the US centrality in the global system. So how would you evaluate, leaving aside what we don't know about whether the agreement sticks, what about what we do know? How do you evaluate it?
Well, first of all, thank you, Sebastian and the Council for having us here today. It's an impossible question to answer, not because I'm going to try and bob and weave around it, but because I do think that the major takeaways from the Iran war, whether it ends one way or the other, whether it ends at all, are going to be more strategic than economic, which doesn't mean there are not geoeconomic consequences. But I think the broader consequences are going to be much longer in coming and more strategic. That doesn't mean they're separate from geoeconomic. But I do think that in terms of framing, let's realize that what's happened in the last 48 hours with the MOU, if it is what it appears to be, and the last several months, really has a structural change in the strategic landscape of the world, which goes far beyond economics. But within the context of economics, I think it has accelerated trends that were already in play without actually changing the direction in any particular way. So when I was sort of writing some notes for this last night, I kept starting with my own words of accelerates the trend of. And I think the one that is the most obvious is to use the Council's head of geoeconomics book title, choke points. I think that the acceleration of the importance of choke points, both physically, as your question suggests, in the Strait of Hormuz being the obvious one, and then the response there too. So, using financial weaponry, sanctions and others, as a choke point, as a means by which countries either seek a way around or through, or they're blocked by. I think one of the major takeaways of the Iran war has been this preeminence now of the dominance of choke points, both physical, financial, and otherwise. And then what that means is countries are going to react. They're going to say, wow, the previous emphasis we had on efficiency is now being replaced by the need for redundancy. So whether it is, just a means to create an alternative source of energy, so whether it is new pipelines or, an acceleration of the adoption of renewables, or even going back to using coal, or other means by which you're self-sufficient, that resilience, that redundancy, because you're trying to avoid choke points. So if there was one major geoeconomic takeaway that I would draw from this, it is the emphasis on choke points and the likely acceleration of countries' need to find ways around those choke points.
So, Natasha, the impact from the war clearly has been felt differentially in different regions. And if you look at that World Bank forecast, which I just cited, the projection for developing and emerging economies has been downgraded quite a lot since January. So 3.6% growth is projected for this year, 0.4 percentage points below what was forecast in January. So, in 3.6 might sound respectable, but these countries are facing a massive entry of young people into the labor market, 1.2 billion people over the next decade. So give us your sense of this growth shock and how it's going to play out in the developing world.
Yeah, I think it's accurate to say that emerging markets have really been hit hardest by developments that we've seen as a result of this war. And if you want to take like a concrete example, if you look on the African continent, at the beginning of this year, there was actually a fair bit of optimism about what the growth picture was going to look like, in part because we were in a situation where we were coming off a series of shocks that had been felt very substantially. You were coming off of COVID, you were coming off of the impact potentially of the war in Ukraine. What's happened as a result of this conflict is that both the sort of obvious thing that like energy markets have been massively disrupted. We're seeing massive increases in oil prices that are being borne very substantially. And frankly, even if we are at some sort of potential resolution, it's going to take months, if not years, for this energy infrastructure and these markets and supply chains to really normalize. But the flip side is that it's not just about oil, right? You're also seeing massive delays in shipments of significant products, particularly refined products that are slow to arrive in ways that are consequential for economies. And frankly, there isn't a lot of resiliency right now in order for those countries to be able to bear. And so something that I think that it's funny, we're talking from the perspective domestically about the consequences of this conflict. And frankly, many of us have been thinking about the ways in which the increase in gas prices particularly are going to bear on political outcomes in the United States ahead of the midterms. I actually think, relatively speaking, we're in a better position than many countries across the globe with respect to being able to navigate the aftermath of this conflict, should we even be close to the aftermath.
So, Jan, one of the impacts obviously is an upward nudge to inflation from the war. So I'm going to ask two questions about central banks. The first is about Japan. Prime Minister Takaichi came in with this reflationary program. It's partly about much more defense spending. It's partly just reflation because she wants to go for growth. Obviously, Japan has a very high debt to GDP ratio in terms of sovereign debt. And so anytime the cost of servicing that debt is pushed up because interest rates are rising, it's not good news for the Takaichi agenda. And the BOJ just this week did raise rates, right? So I'm wondering how much of could we imagine a situation in which the Takaichi government has to really back down from its agenda?
I don't really see that as a high risk. I think what we're seeing right now from the BOJ and what we have seen since early 2024 is normalization mode after a very long period of negative or zero interest rates. This was the fifth hike to 1%. So we're still at a level that is, I think, below where you'd expect it to be. If we're closer to 2% inflation in the longer term, we still have another hike at the end of this year or beginning of next year, and then one more in 2027. That takes you to 1.5%, and that basically would complete, in our view, the return of Japan to a more kind of normal macro environment. The Japanese economy has a lot of headwinds. The demographics have been bad for a long time. Trend growth is low. GDP growth is low. But if you look at the performance relative to those supply side realities, the performance has been pretty good. I mean, you can see it in Obviously, the equity market, which has been very, very buoyant, really outperformed most. But you can also see it in more standard economic indicators. And we have seen, I think, a return to normalcy. On the fiscal situation, the debt level is very high, but the deficit is actually reasonably moderate, sort of 1 to 2% of GDP for the general government deficit. And over the last decade, the debt to GDP ratio has been stable. So I'm not saying there's a lot of fiscal space. There will be constraints on how much the Takaichi government really can do on the fiscal side. But at the same time, it looks a bit more stable than some of the, perhaps slightly overheated rhetoric that you sometimes hear in markets.
Okay. So second central bank is obviously the Fed. I want to ask you about that too. The Fed didn't change rates, but Chairman Kevin Walsh, first time he's chairing the meeting, did roll out a bunch of other initiatives about how he wants to put his mark on the institution. Chief among them is that he doesn't want to communicate quite so much. And so I wondered if you could comment on his reluctance to comment.
Yeah, I mean, for now, the changes are still relatively small. We can get to the meeting and what the signals were. I mean, he basically said we have, these various task forces that are going to look at a range of things, including the balance sheet and including Fed communication. And at the end of the year, or maybe early next year, there will be some significant changes. It wouldn't be shocking if the dot plot, the 19 submissions that get published for where the funds rate is going to be, if that goes away or at least gets heavily modified. And he sort of nodded in that direction at the meeting yesterday by not submitting dot himself. And press conferences, I think, is a little bit less clear. He said press conferences can be helpful, but you need to actually have something to say. And so implying that maybe that's not true every time they have a meeting. At the same time, I also think there's a little bit of a disincentive for him to sharply reduce the amount that he communicates, because if the other members of the committee still communicate, and I think they will still want to, and it's going to be pretty difficult to keep them from doing that, then you kind of reduce agency if you don't communicate much yourself.
Unless you put an Alan Greenspan, which was to punish the ones who want to communicate too much by suddenly giving them the assignment of addressing a church hall a very long way from Washington at 8 p.m. to a hostile audience, and then they tend to communicate less after that.
I mean, you would know better than me, but was that not sort of in the second half of Greenspan's very long term that he managed to sort of rein people in that way?
Yeah.
So I think it's going to take a little bit of time for Walsh to establish that same kind of control. I mean, just on the meeting was more hawkish than we expected. I mean, 9 of the 18 people that did submit dots had one or more hikes in 2026. The inflation forecast for next year was a little bit higher. And Walsh in the press conference said something that I think could be important going forward, which is that he thought markets can provide a really important input. I'm not paraphrasing it 100%, but very important input for policy. And I think that raises the risk of sort of feedback between markets that try to figure out what policymakers are trying to do and policymakers that try to figure out what markets expect them to do. Markets can do a lot of things, but they do need, I think, some...
Was it clear if he meant the bond market or the equity market?
Sorry?
Did you think he meant the bond market or the equity market? Is this a statement about equity market bubbles, or is it a statement about bond market interest rates?
I read it, it's not clear, and I think we need a little bit of clarification. I read it more as when markets are pricing hikes or cuts, then policymakers, may want to follow that. I mean, I hope that's not the right interpretation, because I do think that can lead to some, interesting Hall of Mirrors types of things.
Natasha, I'd love to come to you on this. I mean, not least because you do run the budget lab at Yale, and this connection between a more hawkish Fed and the fiscal outlook must be something you thought about.
Totally. And I want to sort of piggyback on some of what Jan is describing, because I too was a little bit confused about this sort of framework of wanting to be able to follow the markets, and felt like the circularity was kind of confusing, because the idea is that the market is pricing in some expectation of hikes on the horizon or staying stable from the perspective of the central bank. They're doing that with cognizance about the direction that they think the central bank is going to go. And so I'm not entirely sure what it means to then follow the market. Does that actually make it more difficult? I actually think there's a really interesting debate to be had, and an interesting academic debate that has been had, about the extent to which central banks should communicate and provide forward guidance for the direction that they think monetary policy is likely to need to go. Part of what Chair Warsh has sort of articulated for an argument against doing more of that affirmative communicating is the idea that the Fed needs to be able to respond in more real time to changes as they occur. As inflation ticks up, they need to be able to adjust, and shouldn't feel like they are foreclosed from making movements because they have somehow telegraphed what they're likely to do over the course of the next many months. So that seems like in direct tension with this idea that somehow the Fed should be following the market, and I wasn't really sure what to make of that. And I wasn't entirely sure whether he, in fact, knew what to make of that, other than to say that he thought that the market had valuable information to provide that the central bank should care about, which I think many of us who think about these issues fully agree with. But it's really about how to internalize some of that information. With respect to what I am worried about the U.S. fiscal outlook and the relationship between inflation that by its latest print was at the highest level that we've seen in this country in the last 3 years, something that should give you a little bit maybe of less sort of nervousness is the fact that basically all of that is energy. Right? So basically all of the increase is telling us something about the nature of exactly the sort of conflict in Iran that we started with this afternoon. But something that should give you more pause is that we are in a quite challenging fiscal situation relative to Japan. Our deficits are running at 6% in this country.
We also have more growth, though.
And we have more growth, and we might have even more growth as a result of what we're soon to talk about with respect to artificial intelligence. But the thing that sort of should, I think, give all of us a little bit of concern about the nature of the U.S. fiscal outlook is that net interest payments are currently something like 3.3% of GDP, and they're expected to rise very significantly over the course of the next few months, years. Every dollar of debt that we're now rolling over in a higher interest rate environment, and that's likely to tick up even further over the course of the next many months. And so I think that we're in a situation where the expectation is that interest is going to consume something like 30% of revenue by 2036. That's up from 19% in 2025. So high interest rates matter, and they matter significantly for the U.S. fiscal outlook.
So Doug, you've spent a lot of your career, I think, studying crunches in emerging markets. And when you see a global tightening cycle, even if it's not a radical one, are your spidey senses tingling in some sense?
Less emerging market focused and more on what we were just discussing, to be honest. I think the days of emerging, I don't want to jinx this, but the days where an individual or even a series of emerging markets can run into trouble, that's spurring the Asia crisis, the Russia crisis, the LatAm crisis, I don't see that on the horizon as being a systemic risk. I do see some of what we were just talking about in the U.S. and other developed economies, that there is nobody left of the old prudent, fiscally, wait a minute, let's be responsible crowd, whether it's Democrats or Republicans.
They're here.
Which is a fine place to be.
Yeah.
I live in Washington, and it's amazing the silence from both sides of the aisle when you hear numbers that are being floated around now for the defense budget, for the overall budget. The reason these things are not progressing in the U.S. is not because there's a real resistance to overspending well beyond our means. 6% deficits not in wartime are suddenly like, oh, well, I guess that's okay. Well, they're not okay, but there's nobody there who politically is going to say it. So your questions about emerging markets, I am concerned that there are isolated emerging markets that are definitely in debt distress or will be. I'm not sure if we'll get into it, but the overall framework for resolving that, the debt restructuring mechanisms that are out there are problematic, largely because China is now the largest bilateral creditor in the world, and they play by a different set of rules. There's been an effort to try and coalesce everybody around a common framework. It gets into very technical stuff, but let's just say it's not working the way it should, even if it's working better than it was when it wasn't working at all. But that doesn't mean I am sanguine about emerging markets. I think there are a couple of big restructurings out there that are going to be very difficult and potentially problematic, one being Venezuela, another being Senegal. But I am more concerned overall by this general sense that debt can simply be increased exponentially without there being a political pushback. And at some point, whether it's the bond vigilantes or whatever that catalyst is, there's got to be a time in which there's a moment in which everybody says that's not good and we won't tolerate it anymore. It's just to date, we have seen no evidence of that whatsoever, so the party keeps going.
Okay, so let's switch over to the kind of bull story for the world economy. We've been talking about the debt and the inflation and the war and so forth, but sometimes it seems like all these concerns are dwarfed by artificial intelligence. Both the scale of the capex, which produces this enormous boost to demand here in the US, and the hope for productivity gains that may follow from the capex. But I guess, the question is always how big and how soon. So I wonder if you could give us your take on how much growth impetus from the capex are you seeing? How much productivity gains do you think we're going to get? And what does it do to unemployment in the labor market?
On all that in 3 minutes?
You can have 3.5.
Yeah, I mean, it's interesting because when you do these sort of roundtables or dinners, if you look at the topics that come up, the top 10, 8 or 9 of them are negative and downside. But then there is one big positive, which is that I do think we're seeing an acceleration in underlying productivity growth and ultimately potential GDP growth. So there are obviously lots of uncertainties about the social impact, but just from an economic perspective, there is some very positive stuff happening. In the near term, I think right now the impact of capex on GDP growth, well, we're estimating that we're getting about a 5 percentage point boost to the overall growth rate of capital spending in 2026. We're also getting a boost from the changes in the depreciation rules. That's probably worth another 2 or 3 percentage points. So it's a very solid capital spending environment this year. Some of that 5 percentage points isn't actually measured in the national income accounts because semiconductors are treated as intermediate inputs. So there's actually some under-measurement. The other point to say is that not that much of the AI investment actually feeds through to GDP growth ultimately because much of it is imported. A lot of the equipment is imported from Asia, so it's massively boosted Taiwanese GDP growth. It's boosted Korean GDP growth. In the US, that impact is smaller. Of course, on the demand side, we also have a positive wealth effect from the increase in equity market values. But yeah, overall, I think this is still relatively modest. It's a few tenths in terms of contribution. Longer term, our expectation has been that we can get about a 1.5 percentage point boost to productivity growth annually over a 10-year transition period as we incorporate AI into the economy. Obviously, there are lots of assumptions around that. There are some offsets as well. So we haven't raised our long-term productivity growth rate and certainly GDP growth rate by anything like 1.5 percentage points. Demographics kind of push the other way, and businesses are redirecting some funds that would be directed towards other types of productivity improvements towards AI. But yeah, I mean, despite the bad demographics, we've lifted our long-term GDP growth forecast from 1.75% before COVID to 2.5% now. And so it's a solid positive story. I think on the labor market, I've generally been in the camp that we're going to have a substantial amount of disruption, and we can have a temporary increase in the unemployment rate, which is what we've seen in past positive technology shocks, but nothing like the sort of numbers that we're hearing out of some of the AI firms. And also, ultimately, if you ask me what's the US unemployment rate going to be 10 years down the road, I'd give you a number that's pretty similar to the current 4 to 5% range.
Okay. Natasha, I think last time we had a meeting a few months ago, you had a pretty firm view on the lack of strong evidence for any labor market disruption from AI. Do you still feel the same way?
Yes, I do. In that if you look at the moment at basically any indicators of AI exposure in different types of occupations, and a lot of these indicators are coming from the AI labs themselves, and you can say that there are problems with the data and we're not doing a good job of capturing it, but like the best that we have at present, you do not see any evidence of differential trends with respect to hiring, with respect to layoffs, with respect to overall composition about the types of workers, a dislikelihood to be hiring new entrants into the labor force, any of that. You see none of the difference between AI-exposed occupations and non-AI-exposed occupations. And so in the data presently, we do not see anything that indicates that there is widespread displacement that is happening at the moment as a result of the technology. And in fact, part of what is giving me a little bit of pause as I try to evaluate this set of facts about the labor market relative to the types of things that you've heard from a lot of these technology executives like Dario Amodei saying, we're on the precipice of 50% of white collar labor being displaced, is that it is for a long time been the case that sort of the pessimistic take about AI was coming from Luddites who didn't really know much about the technology and were fundamentally kind of suspicious of it. It is now the case that what is happening is a lot of companies who themselves are trying to deploy AI in ways that are productivity enhancing and ultimately revenue enhancing for their firms are finding that they haven't quite figured out how to do that yet. So you're hearing stories about how, Uber went through its entire compute budget in the first 3 months of this year, or at Google, they were trying to get everyone to use a bunch of these tools in useful ways. And what they found was their employees were token maxing. So we're using chatbots to ask them what time it is rather than looking on their computers in ways that were taking up a lot of compute and ultimately not super productive. And so all that is to say that I think that I suspect that we are in relatively early innings with respect to seeing massive impacts on the labor market as a result of AI. That said, I have to think that it is coming in that, and I'm sure all of you are having this experience as well, where a lot of the types of work that I do a lot of research, a lot of the types of work that I do where traditionally I would spend time with research assistants and, go back and forth many times on, trying to learn enough to be able to come and do this briefing this afternoon. Basically, AI is better than the best research assistants that I could marshal. And so you have to think that means that there is going to be less of work particularly for early career stage types of people in the economy, but we are just not seeing that yet.
Doug, let's take this to Europe. There's a paper floating around the internet. This is my last question before we open it up to members, so get your questions ready. And this paper called Europe 2031 sort of tries to paint the picture of what's going to happen in AI geopolitics, particularly how it impacts Europe. And it's sort of one of these, incredibly depressing narratives that essentially, describes Europe, every time AI accelerates a bit more, they think, oh, we really understand, we're going to have to do something about this. And they do kind of 20% of what they should do. And then it accelerates some more, and they do another 20%. And they're so far behind the curve that at the end, they've got no significant compute, no bargaining power as to access to AI. And the US, which is short of tokens, because that's where we are, says, well, we need the tokens for our own economy, you can't have any, or we're going to throttle you back. And by the way, if you'd like some, you need to hand over ownership of ASML, your lithography company. I mean, this is just a cue for you to talk about Europe in any way you'd like, but I mean, there does seem to be, we go through these phases of somewhat optimism. Oh, Germany has changed its constitution to allow for more government borrowing. There's a Draghi report, and then there are kind of periods of downgrading of expectations on Europe. And I'm kind of on a downgrade cycle right now, but where are you?
Well, it's funny because we've had this conversation on the various panels I've done with you over many years, and whether it was AI specific, as your question was this time, or any other catalyst, it's really the same story. It's just accelerated. But I mean, Europe famously acts only in a time of crisis, and yet it fails to recognize a crisis when it is in front of their face. So even before AI, Europe has all of the makings, watching this Trump administration actually accelerate the need for Europe to say, well, whether it's what Macron calls strategic autonomy, whether it's defense specific, whether it's on a variety of other areas, Europe really needs to step up and do stuff. Draghi report, letter report. I always say this, I feel it's incumbent upon me to do it every time I'm up here, to say the IMF did a paper in 2023 which showed that the euro area can issue 15% of euro area GDP through a common borrowing instrument with absolutely no incremental cost to Europeans whatsoever, just because of the added liquidity. That was before Trump made the US dollar and the financial system even more of a there is no alternative, but please give us an alternative scenario. Europe does not actually step up and do it. Whether it is as a pre-AI or a post-AI, they seem incapable of stepping up and declaring a crisis that catalyzes the political necessity to act, when in fact those of us taking a step back would say, this is a crisis. On AI specific, it's actually worse than your question suggests, although I can't say that the paper is right or wrong. I haven't read that specific paper. But if you look at where AI is going, it is really now on the back of the Trump administration's export controls on the Anthropic models this past week. This is a real crisis, because now the US has said, we have the ability. By the way, even if they were to remove the export controls today, the crisis is already there. Because what they've said is, we have the ability, at a whim, to turn off your access to one of the most fundamental building blocks of the 21st century economy, right? So some of the G7 leaders actually acknowledged that this week, and they said we have to step back and realize what this means. Well, that's what it means. It means you have access to a US set of models, which can be turned on and off at will. Again, there's always been the risk of a kill switch in some of our defense provision to Europe. Well, this is a blatant kill switch without even any ambiguity whatsoever. Then you've got the Chinese models, which again, depending on who you talk to, are 6 months behind, 18 months behind, whatever it is, but they are the alternatives. And nobody really wants to go to the Chinese model, except there is an appeal to an open source model, which some of the Chinese models are. Not all Chinese, and not all open source are Chinese, but an open source model means you can download it on your local computer, and then if the US decides to execute the kill switch via export controls or otherwise, then you have something you can still work with. That makes these alternatives more palatable, even if on their face they aren't. But note, I said there's the US models, there's the open source, primarily Chinese models. What I didn't say is there's the European homegrown models. So the Europeans have Mistral, the French model, and I was mentioning this to you earlier in the lunchroom, Sebastian, that I learned this week, Mistral, the French European Great Hope, is much smaller than its American or Chinese competitors. But Mistral trains its model in, dramatic pause, the US. Because European copyright and data protection laws are so overbearing from their perspective, that they can't take the risk of actually training their own competitive model in their own EU regulatory environment without running the risk of legal jeopardy, which would undermine the entire exercise in the first place. So I am hoping that Europe wakes up. I'm hoping that the Trump administration's policies have spurred them to recognize a crisis when it's in front of their face. But I'm skeptical that that is going to actually be the moment that we're watching right now.
Okay, who has a question? And please remember this is on the record.
It's on the record?
I didn't want to tell you, Doug, but I'm telling the members.
First, I so applaud your Nick colors.
Oh.
Very well done.
Nick's in 5.
Yeah. You guys are all in the if I go back up to 30,000 feet, you were all in the business of forecasting. And it struck me as you were talking that all the sort of big risks that people used to look at came from outside, but with the apparent end of rules-based order, et cetera, the risks are actually quite homegrown, like a lot of the Iran turmoil in the world came straight from Washington. And even some on the positive side, the AI changes are coming from the US. We're used to looking at the black swan coming from outside, and now it seems to be coming from our home. Can you talk about how or whether you've changed the way you actually forecast and think about it as a result?
Who wants to crack at that?
I can take a stab at it. I would say, well, if I go back to the kind of pre-2008 period, I basically started doing this in the late 1990s. Then I actually thought a lot of the risks were coming from inside the financial system and inside kind of the endogenous feedback in the economy or between the economy and the financial system because of the weakness of private sector balance sheets and the private sector financial deficits and the over leverage. So that's less obviously been much less true since the financial crisis, or maybe since the aftershocks of the financial crisis. Right now, I would say, the U.S. So if you define inside and outside as domestic and foreign from a U.S. perspective, I'd say you're right. A lot of the kind of shocks in one direction or the other, and it could be negative shocks for activity, it could be positive shocks for AI, does come from U.S. policy. So figuring out what's happening with U.S. policy and what happens in the U.S. and what the impact is on other economies along the lines of what Doug was talking about in terms of European access to AI is more important. I mean, one thing that we've definitely beefed up is our Washington economist, Alec Phillips, has a much more prominent role in the team than would have been the case 10 years ago. I mean, he's always been great, but he now is, I think, much more top of mind for people than was the case. And if I look at Goldman Sachs as a whole, not just investment research, which I oversee, but also the other areas where people think about macro outcomes, we've definitely beefed up the amount of resources that we're devoting to figuring out what's happening politically in the U.S.
Sure. Do you want to go quickly? I want to get more.
I was just going to say that I feel like there's needed to be a certain nimbleness in forecasting, in that the effective tariff rate has changed over 85 times over the course of on 85 different days in this administration. Flip side, I think some of the sort of volatility and the threats to institutions that we've seen over the course of the first year and a half have longer term consequences for things like dollar dominance and the safety of the U.S. and our stability. And I worry that we at Budget Lab, but more generally, are not doing the world's best job at thinking about how to contextualize some of those consequences in the long term.
Mm-hmm. Just, you asked how are things changing. I travel a lot less because I'm based in Washington. And so I used to be traveling the world to sort of assess the risks. And now I just stay home. And my background, as Sebastian mentioned, was originally in emerging markets. So I have the curse of living in Washington and having an emerging markets prism through which to view the events of the day.
Yeah, exactly. I asked you about which emerging markets are in trouble, and you basically answered about the US.
Yeah.
Let's go to a question here.
Thank you. Question to you. Sebastian mentioned that there were two issues a little bit in tension with each other, growth in CapEx and productivity growth. My question to you is markets. Some of us are old enough to remember 1998, 1999, valuations going through the roof. There was no NPV that could justify these valuations. Are we in the same situation today with the valuations of companies going public, especially since a week from today, SpaceX will be integrated in the indices. And so this is going to proliferate all over the market and the markets.
I mean, I look at the macro side rather than, individual companies. I mean, clearly valuations are very high. If you look at it on a backward-looking basis, the, Schiller PE now is not too far from where it was in, 1999 or early 2000. So, it's a very highly valued market. I'd say one big difference relative to the late 90s is the strength of earnings, because if you looked in the late 1990s, certainly in the national income account measures, profits actually started to come down in 1998, 1999. So by the time the market peaked, profits were already on a downward trend. Margins were on a downward trend. It wasn't quite as obvious in the S&P 500 numbers until later, and there were also some restatements. But right now, earnings growth has been quite dramatic. First quarter, we had S&P 500 earnings per share growth. I think it ended up in the high 20s for the median S&P company. It's like in the mid-teens. And as far as you can make out from the national income account measures, there's also strong growth there. So I do think that's one difference. Another difference is that the financial imbalances, which became even more severe once you got into the sort of 2006, 2007 period, they were already pretty significant in 1999 and 2000. The private sector was running a financial deficit of 5 or 6% of GDP. The amount of net borrowing in the corporate sector, a lot of this was concentrated in the corporate sector with the telecoms boom. We're not seeing anything like that at the moment. So I would say we have a very highly valued market, but at the moment still strong profit growth, and therefore I think still some support for where markets are going to be. But I would watch, margins very closely. I'd watch things like, aggregate financing gaps in the economy and private sector balances very closely, because this could change.
But I wonder whether, some of the, more comforting metrics on the public market reflect the fact that since 1999, the private markets have grown out of all recognition, both on the debt side and the equity side. And so a lot of what might have dragged down the numbers in the past, you don't see it anymore because it's all private. So if you look at, OpenAI's valuation in the secondary market is way below its last valuation in the round that it did. If you look at the private credit runs that have been going on, I don't know, I feel like there may be similar problems, but they're just less visible because they're not public.
I similarly share that view, and I'll say, if you look at these sort of three mega IPOs, SpaceX already and Anthropic and OpenAI on the horizon, taken together, they exceed by almost 2 times the size of the IPOs in the internet bubble from 1995 to around 2001. And when you look at analysts who are talking about these companies, what they say is that essentially the way that the valuations can be justified is as if you are pricing in something like a monopoly or an oligopoly outcome for these firms, that we're in this sort of winner-take-all race, and at the end, these are the firms standing such that everyone is paying for their models, and they're the best models and all of that. Something that seems hard for me to grapple with is I haven't quite understood that sort of revenue case for these firms ultimately, in that it strikes me that these are pretty competitive markets at the moment. And it's not obvious to me that there is going to necessarily be it seems likely to me that you're going to be in a world in which there are going to be a few very dominant players. It seems likely to me that some of us are going to need access to the very best LLMs, but also some of us in the way we use AI isn't necessarily going to be willing to pay for those types of LLMs and is going to be fine with a substitute that's almost as good but much cheaper. And so in that sense, like, how do we justify the valuations that seem monopolistic or oligopolistic in a market that feels more competitive than that? It seems an open question to me that I don't quite know the answer to.
Let's go for that.
You shouldn't need a microphone in this smaller room. But, actually, the most interesting question that your fabulous session has come up is a military one, which is choke points and the future of the military. But I'm going to let that go because that's not your subject. I'm stunned by all the things that not only don't we know, we're not doing research on, that we have very unusual financing mechanisms between the users and the developers of these big models. How do you analyze those? Where are they going? You have CapEx spending, which is doing what traditionally was an operations function. It's ultimately going to train models, not so much to build capital stuff. We have a lot of talk about open source. We think open source software is much more vulnerable to hacking and to being used in a hacking, but we don't really know. I mean, why?
So the question is,
why isn't there more relevant research going on in this? Even the definition of product.
I feel like Natasha might have some research on this.
But it's hard. I think part of the challenge is that we've all been circling around the sort of like known unknowns, but the unknown unknowns are much more challenging in that it becomes one of the things that I've been grappling with is I've been thinking a lot about private credit. And I've been trying to understand the extent to which private credit and a potential sort of bubble collapsing where you start to see a lot of the AI investments that these firms are funding through private credit vehicles start to go bad. And so what does that actually mean from a financial stability perspective? And the answer to that question is it is just genuinely really hard to know, because if you look at public credit markets, things like bank loans, for example, we have like a lot of information about the extent to which there are interconnectivities between different types of financial institutions, about who ultimately holds the bag, about how to think about the ratings that are coming on these types of debt instruments. Whereas for private credit, we just know much less, in part because the word private is in the name, right? That is sort of like, in fact, there is some information, and Apollo's trying to be really transparent and all this stuff, but like the extent of knowledge that we have about the actual sort of relationships and the exposures and where they lie in our financial system are much weaker than more developed public credit markets. And so all that is like a long-winded way of saying, I feel like part of my challenge as an economist trying to analyze in real time a lot of these developments is I don't necessarily have all the information or tools that I might want in order to be able to do that important work.
Perfect. An economist
and
with
therefore,
humility.
we need to make a lot of assumptions and do our best, which is what we are trying to do. And our research focus
let's
needs
go
to
to
be
another
well
question.
informed.
Let's go over here to Elkar.
Thank you, Earl Carr, CJPA Global Advisors. Thank you, Sebastian, for a fascinating discussion. Given choke points and given that countries will be focusing more on internal renewable energy type sources, do you think that one of the byproducts of the Iraq war, the war in Iran, will be that the U.S. petrodollar will decline and the internationalization of the renminbi will increase, given that global supply chains are so embedded with China?
Doug?
I think the first part of your question, yes. The second, not so much. I think that the petrodollar foundation from decades ago, which was U.S. provides security, the Gulf states agreed to denominate oil in dollars, and they recirculate those dollars into investments into the US. I think that that is breaking and going to continue to break. Whether the renminbi becomes the beneficiary of that is probably a vast overstatement. I'm not sure what comes next. I think the renminbi, certainly on the back of the choke points, the manifestation in the Iran war and elsewhere, clearly the dollar's use as a bilateral trading currency is being selectively undermined. It's not being undermined overall as a reserve currency. But if and when the Gulf states at the end of this 60-day period and then thereafter find that U.S. security ain't what it was cracked up to be, and that the U.S. withdraws in a way that they are not comfortable with, they're going to have to rethink, because they're going to have to redeploy their assets in a different way. It makes more sense for them to be actually denominating oil in a trade-weighted basket of currencies, just from an objective standpoint, if you didn't have this implicit/explicit petrodollar deal. So if the security part of that becomes more questionable, then all of the other steps become a little more vulnerable to change. But I don't think the renminbi becomes the de facto beneficiary of oil priced in renminbi as opposed to dollars. I think it's going to be something much more multipolar.
I wonder whether either Jan or Natasha wants to come in on this, because I'm always a bit confused by this petrodollar argument, in the sense that if you ask the question, why do people hold dollars? Is it because defense comes from the United States, or is it because they want to hold dollar assets because the US economy generates very attractive, very liquid, very high growth, technology connected opportunities to invest? I would say it's overwhelmingly the second. It's people hold dollars because they want to buy stuff with dollars, assets in dollars, because US capital markets are so attractive. It's not really about who provides the Patriot missiles.
I very much agree with that. And by the way, look at how foreign investment in China has basically collapsed in recent years. No, that is another argument against this.
Yeah, I mean, China has great technology, but it also has overcapacity in all these technologies. So if you're a shareholder, it's not great to buy stocks in BYD. Yes, let's go over there.
I'd like to ask a naive, hopefully not Luddite question. About 2.5 years ago, even the leaders, including Musk, of AI companies said they would entertain a 6-month pause to allow the major economies, basically the US and China, work out a regulatory regime. That seems like an awful long ago world. But in your conversation today, you touched on two things which remind us of the need, or perhaps the need, for state control over the new technology. One was the recent kill switch issue that just arose this week. And the other was back when Hegseth and Anthropic came to blows back then. You, Sebastian, mentioned a 6-month or so or 18-month lead over China's technology. Obviously, restraint here, and there's also the states in our federal system which also threaten to regulate. The question then is there still an opportunity for the major powers to slow the development, to establish a common regulatory regime, or is that such an idealistic, fantastical vision at this point that none of you forecasters have to take it into account at all?
I worry that it is a little bit of an idealistic vision in the following way. If you take seriously what some of these executives at these leading labs are saying, and they're saying different things at different moments in different audiences at the moment, where you had Sam Altman on CNBC recently say he doesn't think AGI is all that useful of a term, and maybe that's there's going to be this stepwise accumulation of improvements with respect to superintelligence, but it's not going to happen all at once. But I think that was more trying to calm all of us, the public, down. I think if you take seriously what they're saying, it's possible that by 2028, 2029, we are going to live in a world of recursive self-improvement, or a world of essentially AGI. If that's true, what that means, if you want some coordinated global regulatory framework, policy perspective, is that in this in the Trump administration,
Let's put that aside. But then we're further behind the ball then, but go ahead.
Yeah, but I mean, what I'm saying a little bit is I see no capacity for the policy process to ultimately find its way to regulate successfully or coordinate across countries successfully based on my belief about how policy ultimately tends to work and how far behind it is relative to understanding this technology and the way in which you might even want to regulate it. And then second fact is I don't actually know what a pause means. Like I actually, like structurally, even if we wanted, I know that they were all saying it, but like even if we wanted to do that, how would one effectuate it? And how would one effectuate it in a world if what Sebastian is saying is true, that China is sort of we have an 18-month lead, then you're gonna say we're gonna pause and then we're gonna lose some of that ground, and to do what exactly? Because we don't have a cogent policy process for what it would mean like even to regulate successfully. And so all that makes me like, I think you need it, but I don't know how you get it, and I'm quite nervous.
Yeah, okay, so we take one last question right here in the front.
Thank you. My name is Vanessa. I'm a corporate member. It's about unemployment and what are your views about that? But I just want to make a comment on that. It's really hard to price, and like you said, there's not enough evidence in the data. But one thing we know is the technology capabilities is so much higher than the business is actually being able to implement, enable. The gap just keeps growing. And we know there's a bunch of resistances that make that happen. Once that happens, that feeling you had about your research assistant can be in a huge effect, because when you look at end-to-end processes in a corporation, it involves a gigantic number of people. So having said that, what are your perspective in terms of unemployment rate for the upcoming years?
Okay, we're going to answer this in a rapid-fire way because we're just about out of time. But so we're going to frame this as unemployment, let's say 3 years from now, 2029. What's your number, Natasha?
4.5.
Doug?
I'm not going to answer that question. I'm going to answer it differently. I'm just going to say I think it's going to be a big problem, and I think there's going to be a political reaction.
You speak rapidly, even if it wasn't rapid fire.
Yeah.
I think
You
it's
made
going
me
to.
give you a number. He's just exactly. Like, yeah, on the one hand, on the other hand.
I'm just saying, I think there's going to be a political reaction to the populist need to address a rising unemployment that is currently taken with a bit of whistling through the graveyard.
Okay, 4.5, 5. Populism is a problem. Jan?
I have a similar view, 4.5 or 4.75.
Okay, all right, there we will end it. Thank you everyone for coming. Thank you to all the speakers. It was fun.